So how are you? Welcome for our session. My name is Mr. John Mark. I'm a lecturer at KCE. I'll be taking you through Advanced Financial Management. So under Advanced Financial Management, this topic has 8 topics. And all 8 topics I'll be highlighting which are highly examinable and which one are also the theories. Because the theory parts, because the mentality of the student is that most of the questions for Advanced Financial Management, it's all about computation. But you also have the theory aspect. Because under Advanced Financial Management, 30 to 40 marks will be theories, and then the rest will be computation. So we'll be focusing on both the computation and the theory part. And our first topic I want us to cover is Advanced Capital Budgeting. And under Advanced Capital Budgeting, what are capital budgeting, or what's capital budgeting project? Now, capital budgeting project involves commitment of funds in long-term projects which are expected to yield benefits in the future. That's what we call capital budgeting decision. So it involves commitment of funds in long-term projects which are expected to yield benefits in the future. And what are some of the characteristics of the features or the elements of capital budgeting projects? Under capital budgeting project, we are saying that they are long-term projects. That's one of the characteristics. They are long-term projects, and therefore, the benefits are realized in the future. So you cannot invest now and get the returns now. So the benefit will be realized in the future. Then number 3 is that they are highly risky. Why? We are saying that we're involving, it involves huge capital, and then the benefit will be realized in the future, of which we have what we call the future uncertainties. Those future uncertainties is what makes that project to be highly risky. And then number 4 is that they involve huge capital. That's the 4th characteristic. And then they are irreversible project. Irreversible means that once the project is undertaken, it's very hard to abandon that project. So those are some of the characteristics of the capital budgeting projects. And what are some of the types of capital budgeting projects? 1, we have what we call complementary or mutually exclusive projects. And for mutually exclusive projects, they are projects serving the same purpose. That means if one project is undertaken, the other one automatically is abandoned. In short, they are substituted. They are serving the same purposes. So if you have 2 projects, for example, you have A and B, and they are serving the same purposes. If you undertake project A, you abandon project B. Or when you undertake project B, you abandon project A. That's what you call mutually exclusive project. You only undertake one project because they are serving the same purposes. Number 2, we have the independent projects. Independent projects, they are projects which does not interfere with each other. That means they can be undertaken independently and does not interfere with each other. And then we have dependent projects. A dependent project, they are projects which depend on other projects. That means if you undertake one project, the other project also need to be undertaken because they depend on each other. For example, assuming you have 3 projects, A, B, and C. You find that project B will depend on project A. And project C will depend on project B. That means if you undertake project C, it must you have to undertake B, and also you have to undertake project A. That's what we call the dependent project. They are projects which depend on each other, and therefore, undertaking one project, you have to undertake all the other projects. And then number 4, we have what we call divisible project. What's a divisible project? Divisible. Now, divisible projects, they are the projects which can start generating inflow even before they are fully completed. So, for example, you can say the rental incomes, the rental houses. For example, you can build one floor. Assuming you have to build a 3-floor building. After you build the first floor, in that case, it can start generating income, rental income, even before it's been fully completed. That's what we call divisible project. And not only their projects, we can also say about even their professional courses. For example, CPA. Most of you students are acting as a capacity as an accountant or assistant accountant. But in this case, you see, CPA is a project itself. But in this case, you are practicing as an accountant or just an accountant assistant. And in that case, you may be you have done CPA up to section 4. You see, in this case, you are not yet a CPA. That means you have not completed this project. But this project, the certificate up to section 4, you can be able to earn your salary having this certificate of section 4 even before you complete section 6. So that one is also a divisible project. So CPA is also a divisible project. You can start generating inflow even before the project has been fully completed. And lastly, we have indivisible project. Indivisible project is the opposite of divisible project. They are projects which cannot yield any benefit until they are fully completed. That's what we call indivisible project. So those are some of the capital budgeting projects we'll be evaluating. And mostly I want you get mutually exclusive projects, because this term will be coming across it several times when we're looking at this. Now, another part I want us to look is what we call project evaluation techniques. Project evaluation techniques. And for project evaluation techniques, they are categorized into two. One, we have non-discounting techniques and we have discounting techniques. So what are the differences? Non-discounting techniques, they are techniques which does not take into account time value of money. And then number two, we have discounting techniques. Discounting technique, they are technique which takes into consideration time value of money. So in this case, I want us to focus mostly on the second one, discounting technique. So you'll not focus on non-discounting technique. Non-discounting technique, you did them in section 3, financial management. This advanced financial management. I'll be focusing on the discounting technique. And there we say that they are technique which takes into account time value of money. And they include, that's discounting technique. Number one, we have discounted payback period. Discounted payback period. Number two, we have the modified internal rate of return. Modified internal rate of return. Number three, we have profitability or the net present value. Net present value, that's NPV. Number four, we have profitability index. Profitability index. Number five, we also have internal rate of return. Internal rate of return. So those are the various discounting techniques we'll be evaluating. We have discounted payback period, modified internal rate of return, net present value, profitability index, and the internal rate of return. And what are the sums? Those are what we call the ideal investment appraisal techniques. And you may be asked, what are some of the characteristics of an ideal investment appraisal method? So one of these characteristics is that, number one, it should be a discounting technique. That means they are taking time value of money. And then number two, they should be using cash flow instead of profits. And then another thing is that they should be considering all cash flow for the period. It's another characteristic. And then another characteristic is that it should give a clear decision on whether to accept or reject a project. And also we can say another benefit or another characteristic is that it should help in ranking the projects. So those are the techniques we'll be looking at. And I want us to start with the first one. We start with the first one, which is the discounted payback period. So, and what's the payback period? Now, payback period is the duration or the time taken to recover the initial investment or the initial capital. So, and we usually say that in financial management, the shorter the payback period, the better and less risky the project is. So, assuming we have two projects, we have project A and we have project B, and assuming both are mutually exclusive, project A requires a capital of 5 million, as well as project B requires 5 million. But now payback period for project A, it's 3 years. But B, it's 4 years. Assuming they are mutually exclusive. So in that case, if you are to select one project, you say project A, the capital is the same, but it has a shorter payback period. So we are saying that the shorter the payback period, the better and less risky the project is. Yeah, and we are saying that the payback period is the duration taken to recover your initial capital. So I want us to do a past paper question, testing on that. Let's open May 2014. May 2014, question 2B. May 2014, question 2B. If you are there, you can read it. And we are told that Mandala Limited is considering investing in one of the two mutually exclusive projects. So they are mutual. So that means you have to select one. The relevant cash flows of each of the project is shown in the table below. And the firm cost of capital is 15%. And the cash flows accrue at the end of the year. So you are given project X and project Y. You are given initial investment for both project X and Y. And then you are given the cash flow from year 1 to year 6. Required number 1. Calculate for each project, number 1, discounted payback period. So we determine discounted payback period. How do we get that? So we have two projects there. We have project X and we have project Y. So I want us to start with project X. Start with project X. So you have your period there. Then you get your cash flows. And then you discount. Present value interest factor. You are given the cost of capital is 15%. So 15% year end. So remember when you're discounting this, we usually have at that table, you have how to get the present value of a single amount. And then we have to get present value of an annuity. Now an annuity is the cash flow receiving the same amount for a given period of time. Single amount, that's where you're getting different cash flow for a specific period. So you have the cash flow, you discount, then we get the present values. So we have year 1, year 2, year 3, year 4, year 5, year 6, and you're given the cash flow. So project X we are given is 25,000, year 1. Year 2 it's negative 11,000. Year 3 we have is 20,000. The one we are given is 15,000. 6 and 5,000. So that's what you're given as the cash flow. Now let's discount. Using the first table or the single period table, 15% in year 1, 15% in year 1, or you can use the formula 1 plus R raised to power negative n. So 15% in year 1 it's 0.8696. Year 2 is 0.7561, 0.6575, 0.5718, 0.4972, 0.4323. Now let's get the present value. How do we get the present value? To get the present value, you just take the cash flows, you divide by the discounting factor. So for example, the first one you take 25,000, you multiply by 0.8696. So I'll have is 21,740. Second one you have it's 8317, which is a negative. The other one is 13,150. The other one is 8577, 2983, and the rest we have 2161.5. After determining your present value, now you accumulate. You get accumulated present value. So how do you accumulate? So you'll take 21,740. You take 21,740, you add negative 8317, and you'll have 13,423. You take 13,423, you add 13,150, you get 26,573. 26,573, you add 8577, you have 35,150. 35,150, you add 29,83, you have 38,133. Then 38,133, you add 21,61.5, you have 40,294.5. Now with that, let's determine our payback period. How do we get that? So how much had we invested in project X? You go to the initial investment, and project X, the initial investment was 38,500. 38,500. So now let's be here. You start from year 1, going downward. You spot where we have an initial investment of 38,500. 38,500. Now 38,500 is in between the 5th and the 2nd year. That's why you have 38,500. 38,500. So now how can we get the payback period? This is how we get the payback period. Our payback period is equals to, you see our 38,500 initial investment it's in between the 5th and the 6th year. So it will be 5 years plus, you need to be specific, and how months. So it's 5 years. Then from there, this is what you usually do. You take the initial investment or the initial capital minus lower limit. You divide by upper limit minus lower limit. You multiply by 12. 12 will represent 12 months. So that means it will be 5 years plus initial capital, it's 38,500. 38,500 minus lower limit. So now let's be here. 38,500, this is the lower limit, this is the upper limit. Lower limit, upper limit. So we are deducting the lower limit. Our lower limit is 38,133. You divide by upper limit minus lower limit. This is the upper limit minus lower limit. And the difference between the two is 2161. Or you can still do this. You take the upper limit, which is 40,294.5, minus the lower limit, which is 38,133. Then you multiply by 12. So, and in that case, you find it's 5 years and 2 months. That's how you get that. So you can look at that before you do for project Y. Project Y, we do the same. We have period there, cash flows, present value interest factor. The cost of capital was 15% year end. We get our present value and then we accumulated present value. Year 1, year 2, year 3, year 4, year 5, year 6. How much was the cash flow? Project Y, year 1, the cash flow we had that 1,000. Year 2 we had 8,000. Year 3 we have negative 4,000. Year 4 is 22,000. Year 5 is negative 10,000. And the other one is 15,000. Then we'll discount 15%. That one does not change. It's 0.8696, 0.7561. Then we get the present value. We say that to get the present value, you take the cash flow, you multiply by the present value factor. So that times 0.86396, you'll have is 26,088. Then we have 60,49. Then we have negative 2630. Then we have 12,580. Here we have 49,72, but a negative. Then we have 64,84.5. Now let's accumulate the present value. We accumulate the present values. So here we have 26,088. You add 6049. So, and you'll have 32,137. That 237, you add negative 2630, you have 29,507, and then you add 12,580, you have 42,087, and then you add negative 4972, have 37,114. That 7,144, you add 6485.4.5, you have it's 43. 598.5. So with that, how much we want to determine the payback period? How much was our initial capital? Our initial capital for Project Y. Project Y, look at the initial capital. We had invested 37,000. So where is that 7,000? So come to the accumulated present value, and you spot where we have that 7,000, and that 7,000, it's in between. You see, this is why you have that 7,000. It's in between the 3rd year and the 4th year. You see, that's where that 7 is. So that means our payback period, it's 1, 2, 3 will be our payback period will be 3 years plus, we want to determine the specific month. To get the specific month, we say that you take the initial capital, which is that 7,000, minus the lower limit. This is the lower limit. The lower limit is 29,507. 29,507. You divide by upper limit minus lower limit. And upper limit minus lower limit, the difference between the two is this, 12,580. 12,580 times 12. Or you can simply just do for 2087, the upper limit minus lower limit, which is 29,507. You'll find the same. And in that case, you'll find that your payback period is 3 years, 7 months. 3 years, 7 months. So now let's comment. Let's comment. The question was, the two projects, remember, are mutually exclusive. If they are mutually exclusive, you need to undertake one. Project X, the payback period is 5 years, 2 months. But Project Y, the payback period is 3 years, 7 months. So which one should you undertake? So in this case, you should undertake Project Y. We say that the shorter the payback period, the better and the less the lower and less risky the project is. So in this case, you say that undertake Project Y since it has a shorter payback period. So you can look at that, what we have done there. So now the second model I want to use to evaluate. The first one we have done is the discounted payback period. Okay? The second one, which is the widely applied and which is the most ideal investment appraisal method, is the net present value. And what's the net present value? Net present value is the difference between the present value of cash inflow and the present value of cash outflow. So we are looking at the net present value. And in the net present value, NPV is the difference between the present value of cash inflows minus present value of cash outflows. So that's how we get the NPV. And what are the decision criteria? Decision criteria. So for NPV, number one, if NPV is positive, if the NPV of that project is positive, you accept. But if NPV it's negative, reject. If it's positive, you accept. If it's negative, you reject. And then, if you're evaluating two mutually exclusive projects, if the two projects are mutually exclusive, and both they have a positive NPV, since for mutually exclusive, you only have to select one, you want to take the one with the higher NPV. So in this case, we are saying that the higher the NPV, the better the project is. So, for example, I want to use the question we had done for May 2014. The one we had done for May 2014. Yeah. For May 2014, we want to determine the net present value. In this case, that's what you can do. We have Project X and we have Project Y. So, this is what you could have done. You just take the period. Let's start with Project X. You just take the period, cash flows. Then we had already discounted present value interest factor 15% in year end. You have already shown there to get the present value. After you get the present value, just add the total present value. And if you add the total here, you get 40,294.5. That's how you get that. So how do we get NPV for Project X? We have said that NPV is the present value of cash inflow minus present value of cash outflow. So our NPV, you take present value of cash inflow, this is the total. And the total of the present value was 40,294.5. We minus present value of cash outflow. How much was the initial investment for Project X? Project X, remember, initial investment was 38,500. It was 38,500. That means our NPV in that case will have it's 1795.5. And we do the same for Project Y. Project Y, you had the period, your cash flows, present value interest factor at 15% for you to get the present values. For the present value, you add the total. You add the total present value, or in this case, you have it's 43,598.5. So that's the present value of cash inflows. So to get NPV, so this one is the same as present value of cash inflows. To get NPV, you deduct present value of cash outflows. Project Y, we had invested how much? We had invested 37,000. So the present value of cash outflow was 37,000. So how much will be our net present value? Our net present value will be 65,98.5. 65,98.5. So now, if you are told to comment, because remember the two projects were mutually exclusive. If they are mutually exclusive, you only undertake one. Project Y had an NPV, has an NPV of 65.98, but Project Y has an NPV of 17.95. So X now Y and NPV here is 17.95.5, and for Y it's 65.98.5. So which one will you select? So in this case, you select Project Y because it has a higher NPV. As simple as that. That's how you compute NPV. And now NPV will be the backbone for financial management. All the other topics will be requiring to get to apply the concept of the NPV. So that's our second model. So you can look at that. So now let's look at the third method, and our third method is the modified internal rate of return. Modified internal rate of return is totally different from the internal rate of return. For modified internal return, it is the required rate of return, assuming that the cash flow generated at the earlier periods can be reinvested to earn more returns. That's when we compute the modified internal rate of return. We are assuming that the cash flow generated at the earlier period can be reinvested back to earn more cash flows. And how do we get the modified internal rate of return? So to get the modified internal rate of return, you get the future value of cash flows. You divide by the initial investment. Initial investment. That's the present value of cash outflow. Then nth root minus 1. That's how you determine the modified internal rate of return. The future value of the cash flows you divide by the initial investment. And then how do you get the future value? You have been used on how to get the present value. This is how we get the future value. And future value number 1, for single amount or single period, and also how do we get for in case of an annuity. In case of a single amount, this is how we get the future value. It's 1 plus R raised to power n. In case it's an annuity, it's 1 plus R raised to power n minus 1, you divide by R. So that's how we get the future value. So those are the two formula you can use. In case it's an annuity, you get that. In case it's a single amount, it's 1 plus R n, and then you multiply by the amount. For the annuity, you take that amount of the annuity, and then you get the future value like that. So now I want us to do an illustration from the past paper. Let's do the question we had previously done. That's May 2014, question 2B, but part 2 now. May 2014, question 2B, part 2. Part 2, you are supposed to determine modified internal rate of return. So how do we get the modified internal rate of return? So in this case, we had two projects. We had project A, project X, and project Y. You can do them separately or you can combine them. So I want to combine them. So you bring your periods, the cash flow for project X and project Y, and then let's get the future value. You see, in this case, it's not an annuity. So we use this formula where future value is 1 plus R raised to power n. And in this case, our cost of capital, remember, it was 15 years. So it was 15 years. 15%, sorry. So it will be 1 plus R, our R is 15%, 0.15 raised to power n. Now, when determining that n, the future value, always start with the last one. And the last one, you denote it 0, 1, 2, 3, 4, 5. That's how we get the future value. And that means, remember we have said that for the modified internal rate of return, we assume that the cash flow generated can be reinvested back to earn more returns. So for example, the first year, remember the project was for 6 years. The project was for 6 years. The cash flow generated at the end of year 1 can be reinvested for the next 5 years. 1, 2, 3, 4, 5. That's where you're saying it's raised to power 5. The cash flow generated at the end of year 2 can be reinvested for the next 4 years. 1, 2, 3, 4. That's why it's raised to power 4. Cash flow generated at the end of year 5, can be invested for the next 1 year. That's why it's raised to power 1. And lastly, the cash flow generated at the end of year 6, remember that was the end of the economic life. It cannot be reinvested again. So that's why you're putting a 0 there. So with that now, that's how you get the future value. Raised to power 5, raised to power 4. So with that, so for example, the first one, you'll be taking that 1.15 raised to power 5, you get that. Then you get that, now you rediscount. So how do we let's get the future value for both project X and project Y? Now this is how you get for project X. You take 1.15 raised to power 5. What you get for project X, you multiply by 25,000. For Y, what you get there, you multiply by 30,000. And in that case, how much will you get? So the future value here you have it's 50, 284. The other one you have it's negative 19, 239. The other one here you have is 3417.5. The one you have it's 19,837.5, 69, and 5,000. Like that. Then for project Y, you do the same. You get the future value here, 1 plus 0.15 raised to power 5. What you get now, you multiply by the cash flow of project Y. You multiply by 30,000. So you multiply by 30,000, you have 341, 13, 992. Here we have 83.5, 2909, 095, 11,500, which is a negative, and then we have 15,000, like that. So now let's get the total future value. So for X, if you add the total future values, you get it's 93, 200. For project Y, it should be 100, 844.2. So those are the future values. So using applying the formula, remember we said that future to get the modified internal rate of return, MIRR, you take the future value of cash flows, you divide by the initial capital or the present value of cash outflow, nth root minus 1. So let's start with project X and then project Y. For project X, the future value we have gotten is 93,200. You divide by the present value of cash outflow. Project X, how much had we invested? We had invested 38,500. Nth root, it was for 6 years. Sixth root minus 1. Then for Y, the future value we have it's 100, 844.2. You divide by the initial investment. We had invested that 7,000. Then nth root minus 1. So what you get, if you do like that, this one you get is 15.88%. And for Y, you have it's 18.18%. Now, this is how we get the modified internal rate of return. So this is what you do to get the sixth root. You take 93,200, you divide by that 8,500 equals. Now to get the sixth root, you press 6. You press 6. Shift. After you press shift, then there is raised to power. We have that for raised to power. Then answer, and then you minus 1. So for example, the second one, you do 100, 844.2, you divide by that 7,000 equals what you get. To get the sixth root, You press 6, shift, and then there is that kind of icon for raised to power. You see that raised to power? Yeah, raised to power, then answer equals, and then you minus 1. Or you can do this. You can do this. For example, 93,200, you divide by that 8,500 equals, then raised to power. Raised to power. This 6 is the same as raised to power. You open the bracket, 1 divided by 6, close the bracket, equals. Okay, this is what I mean. If you are given, get the fourth root of 9. Fourth root of 9. How do you get the fourth root of 9? Now, this is how you can do, the easier way. You just take 9 raised to power, you open the bracket. This 4, it will be 1 over 4. You close the bracket, equals. As simple as that. Another one, square root, not square root. But now you want fifth root of 90. How do we get the fifth root of 90? The easier formula is to do this. 90 raised to power, you open the bracket. This fifth, you do it 1 over 5. You reciprocate. You open the bracket, 1 divided by 5 or 1 over 5. You close the bracket, equals. That's how you get that. Good. So, now let's make the decision. Remember the two project X and Y, they are mutually exclusive. Based on the two projects, which one would you prefer? So in this case, you prefer project Y, since it has a greater internal rate of return. Another concept is that making decision criteria, we usually accept the project if the modified internal rate of return is greater than the cost of capital. If the modified internal rate of return is greater than the cost of capital, you accept the project. In this case, our cost of capital was 15%, but you can see for project S is greater than 15, also it's greater than 15. But the two are mutually exclusive, so you take the one with the highest modified internal rate of return. Good, so we look at that question before I do something else. So now let's look at the fourth concept of discounting technique. And in this case, I want us to look at the profitability index. And profitability index is a relative measure of performance. It's a relative measure of performance. And in this case, it is expressed as follows. How do we determine the profitability index? Profitability index is equals to present value of cash inflow you divide by the present value of cash outflow. In this case, we are trying to look at what is the ratio between the inflows and the outflows. So that's how we get the profitability index. Present value of cash inflow divided by the present value of cash outflow. And then what are the decision criteria? If profitability index is positive, when it's positive, that means the inflow are more than the outflow, you should accept the project. But if profitability index is negative, that means the outflow in this case are more than the inflows, you reject the project. That's how you get the profitability index. And then we are saying that it's a relative measure of performance. And profitability index is mostly applicable when there exists capital rationing for independent projects. So whenever you have the capital rationing, we not necessarily use the net present value to make a decision. So in this case, that's when we use profitability index. So it's not a must that the examiner will tell you to compute the profitability index. No. Whenever you see that there is a statement of capital rationing, that's when you need to apply profitability index. And what is capital rationing? What's capital rationing? And capital rationing occurs when there is scarcity of investment fund to undertake all viable in independent project. So that's when we say that there is capital rationing. And there are two types of capital rationing. We have what we call soft or internally generated capital rationing, and we have hard or externally generated capital rationing. And the difference is one. For the soft or the internally generated capital rationing is the scarcity of funds due to actions of the management or due to factors within the control of the management. But for the external or hard capital rationing, it exists where there is scarcity of fund due to factor not within the control of the management. So let's start with the soft or internally generated capital rationing. And this occurs when we say that when there is within the control of the management, where the scarcity is within the control of the management. It may occur due to number one, when the management refuses to issue more shares to avoid dilution. In this case, the company can issue more shares to acquire more capital. But in this case, the management, they fear dilution. You see, the more you issue more shares, there will be other shareholders. In that case, they lead to dilution of ownership. Or number two, they fear to avoid commitment of huge payment of interest in case the company borrows funds. In this case, assuming the company is creditworthy, that means they can be able to get the finances to fund all the other projects. But in this case, the management fears that risk of payment of interest. Remember, the interest payment or the risk associated with borrowing is known as financial risk. And then another circumstance is when the management has set a limit on the budget. If you had budgeted that in this year, we had budgeted like 300 million for investment. And then all viable projects, you get that they require 350 million. And in this case, the finance manager decides that we need to stick to our budget. Yes, the projects which are viable require capital of 250, but in our budget, we had already budgeted for 300. So in that case, you cannot exceed the amount you have. And then lastly, when the project can only be financed using internally generated fund. When we talk about the internally generated fund, we are talking about the retained earning. If that is provided in the MOU for the capital clause, that all the long-term project can only be invested using the internal funds, that's the retained earning. In that case, you cannot borrow. That is something which is within the control of the management. So those are the circumstances under which it gives rise to soft or the internally generated capital rationing. Good. So now let's look at the hard or externally generated capital rationing. And for hard or externally generated capital rationing, we say that is a scarcity of funds due to factors not within the control of the management. And it may occur due to, number one, when the capital market is depressed. When capital market is depressed, that means at that time, they are not giving out cash. It's, for example, you trying to borrow someone cash in January. So in that case, even if your friend will tell you, this is January, I have nothing. So in that case, we are assuming that the capital market is depressed. And then, where the cost of issuing capital is too high. Now, when the flotation cost or the issuing cost is too high, in that case, it can discourage the management from borrowing more funds to undertake those projects. And also when there is a high demand of investment fund by well-established company. You as a small company, it will be hard for you to access that capital. And lastly, lack of security when borrowing. Remember, when borrowing, you need to have a collateral. In this case, you may be willing to borrow and you are creditworthy, but now the problem is that you don't have security to secure that loan. So those are the circumstances giving rise to external generated funds. Now with that, I want us to do an illustration. We do an illustration. Go to your past paper and open June 2010 question 1C. June 2010 question 1C. That's June 2010 question 1C. Kihingo Limited is considering a 5-project proposal as summarized below. So we have the project A to E. We have initial investment, annual revenue, annual fixed cost, and life of the project in years. Additional information number 1. Variable costs are 40% of the annual revenue. Number 2. Project D and E are mutually exclusive. Number 3. Each project can only be undertaken once and each is divisible. Number 4. Assume that the cash flow are confined to within the lifetime of each project. The cost of capital is 10%. No inflation exists. There is no risk. No taxes exist. All cash flow accrue on anniversary date. Assuming that the company has set a limit of 40 million for investment in project at time 0. Determine the optimal allocation of 40 million among the project and the resultant maximum net present value. So that was the requirement. So you see in this case, the examiner has not mentioned you compute profitability index. But they have said that assuming the company has a set a limit of 40 million So that's a limit. So that means there is capital rationing. Eh? For example, if you go back to the project, can you go back to the project? And then you look at the initial investment. For initial investment, if you add the total initial investment, that's 10, 30, 15, 12, and 18. That is more than 40 million. So in this case, that means there is capital rationing to undertake all those projects. So in this case, that's when we apply profitability index. So how do we evaluate that? So I want us to do each project. And first of all, you have to determine the net present value. And net present value is the present value of cash inflow, present value of cash outflow. So let's start with project A. Project A. How do we get NPV? So first of all, you get the inflows. And we are told that project A has annual revenue. Let's go to the annual revenue. How much is the annual revenue? Annual revenue is 20. Minus, let's go to additional information number 1. Number 1, we are told that variable costs are 40% of the annual revenue. You raise variable cost. It's 40% of annual revenue, and revenue is 20 million minus the fixed cost. We are given the annual fixed cost for project A, it's 5 million. What do you get? And in that, you have 7 million. Or you can do this. If the variable cost is 40% of the annual revenue, that means how much is the contribution margin? That means contribution margin is 60%. If the variable cost is 40, contribution margin is 60. So you can also do, you take the revenue which is 20, you multiply by 60% to get the contribution margin, and then you deduct the fixed cost of 5. You still get 7. And then we will discount times, remember the lifetime of the project. Project A has an economic life of 3 years. And what you are given there is the annual revenue. So that means it's an annuity. When you talk about it's an annuity, you are getting the same amount for a given period of time. So this one use the second table, the annuity. So you'll discount present value interest factor of an annuity. Cost of capital given is 10%. And project A, the life of the project was for 3 years. So it's 7 times. So in this case, we are using the annuity table because the cash flow given here, you are given annual cash flow for the next 3 years. The cash flow will be the same. So 10% for 3 years you have is 2.4869. So in total you have it's 17.4. So that's our present value of cash inflow. So to get NPV, you have to raise present value of cash outflow. So we go back to project A. Project A, the initial investment. How much was the initial investment? And the initial investment was 10 million. So present value of cash outflow is 10 million. That means our net present value will be 7.4. So with that, now let's compute profitability index. How do we get profitability index? We say that profitability index is the present value of cash inflow divided by the present value of cash outflow. So you'll take present value of cash inflow, in this case is 17.4, you divide by the present value of cash outflow, which is 10. So that means our profitability index will be 1.74. Let's now do for project B. Project B, how much is the revenue? The revenue is that million times 60%. Remember, we have said that if the variable cost is 40, contribution margin is 60. And then I deduct the fixed cost. How much was the fixed cost for project B? Annual fixed cost for project B is 10 million. So I'll get the profit of 8. Then we'll discount this 8 times present value interest factor of an annuity, 10%. Project B had economic life of 5 years. So let's go there to the life of the project. For project B was 5 years. So it will be 8 times. You are using an annuity table. 10% for 5 years will be 3.7908. So with that, you will have it 30.33. So that's our present value of cash inflow. To get NPV, you deduct present value of cash outflow. So how much was the investment? Initial investment for product B? Product B, initial investment was 30 million. So that means our NPV will be 0.33. Good. So now let's get the profitability index. Our profitability index, you take the present value of cash inflow, which we have 30.33, you divide by present value of cash outflow, which is 30. We found we have 1.01. Go to project C. Project C, we do the same. The revenue for project C, it's 18 million. You multiply by 60%, that's the contribution margin. Then you deduct fixed cost. And our annual fixed cost was 6 million. So what will we get there? So we'll have 4.8. Then you discount that. So when discounting this, how much was the economic life for project C? Project C had economic life for 4 years. So you are using present value interest factor for annuity is 10% for 5 years. So 10% for 5 years will be how much? 10% for 5 years, you have it 3.1699. So how much will be our present value of cash inflow? You have it's an amount of 15.22. So that's the present value of cash inflow. To get NPV, you deduct present value of cash outflow. How much had we invested in project C? It required an initial investment of 15 million. So that means our net present value will be 0.22. So that gives us a profitability index. To get the profitability index, you take present value of cash inflow, of which we have 15.22. You divide by the present value of cash outflow. And for the cash outflow, we have it's 15. So in that case, we'll have 1.104. Sorry, 1.01. 1.014. Good. Let's go to project D. Now for project D, our revenue is 17 million. You multiply by the contribution margin, which is 60%. Then you deduct the fixed cost, and our fixed cost was 8 million. So you find that we have 2.2 as our profit. Then you discount times present value interest factor of an annuity, 10%. Economic life for project D. Project D had economic life of 10 years. So it will be 2.2 times 10% for 10 years. Using an annuity table, you have it 6.1446. And you have a present value of cash inflow of 13.52. So that's present value of cash inflow. So to get NPV, you deduct present value of cash outflow. How much had we invested in project D? Project D, investment was 12 million. So that means our NPV in this case will be 1.52. So let's get our profitability index. Profitability index, and our profitability index will be 1.126. And lastly, we had project E. Project E, we do the same for project E. And project E, our revenue was 8. You multiply by 60% to get the total contribution margin, and then you deduct the fixed cost. How much was the fixed cost for project E? Our fixed cost was 2 million. So you have a residual of 2.8. Then 2.8 you will discount times present value interest factor of an annuity, 10%. And it had how many economic life? Project E. Yeah, the economic life was for 15 years. For 15 years. So you have 2.8, 10% for 15 years. You get an amount of 7.6061. So the present value of cash inflow you have is 21.29. That's our present value of cash inflow. You deduct present value of cash outflow. How much was the initial investment? For project E. Project E had initial investment of 18 million. So that means our NPV will be 3.29. Good. So now let's get the profitability index. We take the present value of cash inflow, which is 21.29, divided by the present value of cash outflow, which is 18. And you have it's an amount of 1.183. 1.183. So look at that before we evaluate further. Good. So can you go back to note number 2? Note number 2. At note number 2, you are told that project D and E are mutually exclusive. If project D and E are mutually exclusive, you make decision based on NPV. If they are mutually exclusive, that means they are serving the same purposes. So for example, let's go to project D. So project D, its NPV, it's 1.52 and its profitability index is 1.126. Now let's go to project A. Project A. Its NPV is 3.29 and its profitability index is 1.18. If they are mutually exclusive, you take the one with the highest NPV. And in this case, project E is better as compared to project D. So that means when evaluating, you will not be evaluating project D. Because project D and E, they are mutually exclusive. And project E has more NPV, has higher NPV as compared to project D. So in this case, we ignore project D. So you only undertake project E. After now you have computed your profitability index, you need to rank the profitability index, starting with the highest profitability index. So now let's start. We have 1.74, 1.01, 1.014, and we have 1.18. So which is the highest? So the highest is this for project A. So that is rank number 1. Followed by E. Our E has an 1.18. So that's rank number 2. Project C, this is rank number 3. And lastly, project B, that will be rank number 4. I'm ranking the profitability index starting with the highest profitability index. So now with the rankings, so now we can do the capital allocation. So now let's do the capital allocation. Remember you are told that we had a capital limit of 40 million. So the capital, it's 40 million. Then our rank number 1 is project A. So that means we should give the first priority to project A. So we start investment project A. Let's go to project A. How much was the capital? Initial investment for project A was 10 million. So project A, first of all, invest the 10 million and we'll have a balance of that million. We have invested in A, so we have a balance of that million. Then we go to rank number 2. Our rank number 2 was project E. So project E required initial investment of how much? And project E, the present value of cash outflow was 18 million. We need to invest 18 million. So that minus 18 will have a balance of 12 million. We are through with project rank number 2. Now we go to rank number 3. Rank number 3 is project C. Project C. Rank number 3 is project C. That was our rank number 3. Project C, how much was the initial investment? Initial investment for project C was 15. So it requires a capital of 15. But here we have a balance of 12. So you only invest what you have. You invest 12 million to get a balance of 0. It requires a capital of 15, but you only invest 12. Why? Because if I take you back to additional information number what? Number 3. Let me read for you number 3. Each project can only be undertaken once and each is divisible. When it's divisible, we say that it can start generating inflow even before they are fully completed. So those are the projects we are going to undertake. So we undertake project A, E, and C. And also you are required, so remember also required that you determine the optimal allocation of the 40 million among the project and the resultant maximum NPV. How do you get the resultant maximum NPV? So maximum NPV, this is what you do. Project A, how much was the NPV for project A? So let's be here. Project A has an NPV of 7.4. So you take 7.4 plus we have already undertaken project E. Project E had an NPV of 3.29 plus C. Let's be here. Project C had an NPV of 0.22. You take 0.22 times. Remember, it was giving us 0.22 if you invest it in full. But in this case, project C, we had already invested 12, and the total investment was 15. So you get that proportion. Yeah, it's 0.22, but this is when we invest the entire 15 million. But in this case, we have only invested 12 million. You divide by 15. That's how you get your resultant maximum NPV, and you have an NPV of 10.8775. 0.775, right? That. So you can look at that. So now let's look at the other technique, and the other technique is the internal rate of return. And the internal rate of return is the discounting rate where NPV is equals to 0. And where NPV is equals to 0, that means the present value of cash inflow is the same as the present value of cash outflow. Then, internal rate of return is computed depending on the nature of the cash flow generated. So this one has several formulas, which will be based on the nature of the cash flow. So let's start with the first one. In case of an annuity cash flows for a specific period of time, we are given a project is generating an annuity for a given or specific period of time. In that case, this is how you compute the internal rate of return. You take the present value of cash outflow, you divide by the annuity. So that's how you compute the internal rate of return. So now let's do this illustration. You are given a project A, B, and C. You are given the initial investment, that's the same as the present value of cash outflow. Then you have the annual cash flows, so that means it's an annuity. And then you are given specific economic life. You are given economic life for example, project A is for 7 years, 6 years, and 5 years. So required, determine internal rate of return for each project. So how determine that? So number one, you have to identify the nature of the cash flow. In this case, we see you are given the annuity, and then you are given for a specific period of time. So in that case, so let's start with project A. Now for project A, we have said that internal rate of return, you take present value of cash outflow, you divide by the annuity. So for project A, how much is the present value of cash outflow? Project A, our initial investment is 10,000. You divide by the annuity. So project A, annual cash flows we have is 2191.2. And then your answer should be into 4 decimal places because we'll be leaving them from the table. So what do you get? 10,000 you divide by 2191.2. So in that case, you'll have 4.5637. Now what you have there, this is not the internal rate of return. You read it inside the table. Inside the table. What do we mean? You take your annuity table, the second table, that's the annuity table, and then project A, the economic life was for 7 years. Project A was for 7 years. Now this is what you'll do. You take your annuity table, you go where you have the periods, up to the 7th year. You go to the 7th year, and then you look at, or you spot 4.5637 across the row. So you go to the 7th year because the economic life was 7th year. Now you spot 4.5637. So in that case, you'll have, it's 4.5638. It will be 12%. Can you confirm it's 12%? Can you confirm 7 year 12% if you get 4.5637? So that means our internal rate of return for that project is 12%. So our IRR is 12%. Now let's do for project B. Project B, our annual initial investment was 20,000. and annuity you are given is 5427.84. That's project B. And then you have said that your answer should be into at least into 4 decimal places. So in this case, you have 3.6847. But this is not the internal rate of return. You have said that economic life for project B was 6 years. So the economic life is 6 years. So what you do, you go to the annuity table on the 6th year. To the annuity table on the 6th year. And then, so you look at 1, 2, up to the 6th year. And then you look across the row and you spot 3.6847. So where you spot 3.6847, then you go upward. You'll get your rate there. And if you do like that, I think we have it 16%. There up is written 16%. So spot that. Hope you're getting 16%. So that means the internal rate of return, IRR for project B, will be 16%. Lastly, let's do for project C. Project C. Project C, our initial investment was 15,000. You divide by annuity. Its annuity is that 240. So what do you get? You take 15,000, that's the present value of cash outflow, you divide by the annuity, you get that. So, in that case, you'll have it's 4.6. You'll have it's 4.6296. That's what you get. And the economic life was 5 years. So economic life is 5 years. Now this is what you do. I want us to do this one together. Because sometimes you can get that this figure is not exactly in that table. So what you do, just go to the 5th year. You go to using the annuity table, you go to the 5th year. And then across the row, we want us to spot 4.6296. 4.6296. So you see it's not there, but it's in between the 2% and 3%. Kindly spot that. On the 5th year, 4.6296 is in between 2% and 3%. It's in between there. So it's in between 2%. Our IRR is there and 3%. It's in between 2 and 3%. So how much is 2%? The rate for 2%, it's 4.7135. Our IRR, the required is 4.6296, this one. And then for 3%, you are given a rate of 4.5797. So how do we get the exact IRR? So in that case, this is what we do. You'll take IRR minus ROA limit. ROA limit. You divide by the upper limit minus ROA limit. That's what you do. If you want to get it specific, you take the IRR minus ROA limit, you divide by the upper limit minus ROA limit. This is what I mean. Our IRR, you take IRR minus ROA limit. So you see our ROA limit, we have 2% and we have 3%. Our ROA limit is 2%. You minus 2%, you divide by upper limit, it's 3%. So you take 3% minus ROA limit. Our ROA limit is 2%, which is equals to our IRR. So what's the rate? Our IRR, the amount is 4.6296 minus for 2%, the amount is 4.7135. You divide by, for 3%, this one, you just replace, it's 4.5797 minus 2%. For 2%, we have it's 4.7135. So it will be like this. IRR minus 2, you divide by 3 minus 2 you'll get 1 is equals to, now you do that. 4.6296 minus that, you divide by 4.5797 minus that, you divide that. And what will you get? So in that case, you will find is equals to 0.63. So that's what you get. So, and then, this one is the same as 1. You multiply both sides by 1, you multiply by 1. That one and that one go. So that means IRR minus 2 is equals to 0.63. So can we be able to get IRR? IRR is equals to, these two you take it to the other side, it will be a positive. So it will be 2, you add 0.63, it will be 2.63%. That's how you get that. So our specific amount is 2.63%. And that's why you're told that it should be in between 2 and 3%. So on that case, I want you to go and try this question. May 2017, question 1B, part 3. May 2017, question 1B, part 3. Yeah, go and try that question. And then the good thing is I've already done that question for the, from the notes you get it. So you try to do that and then you get the rate. So that was how to determine IRR in case of annuity cash flow for specific period. Let's look at to other natures of cash flows. Number B, we look at IRR. We look at IRR in case of 1-year project. How do we get an internal rate of return in case of 1-year project? So in this case, our IRR is equals to the future value, or this is the amount you expect to receive at the end of year 1, and then you divide by what you invested, present value of cash outflow, and then you minus 1. Then number C, IRR in case of annuity cash flows, to infinity, or to perpetuity. This way you are receiving an annuity of a specific amount, which does not change, to infinity or to perpetuity. So how do we determine our internal rate of return? So our annual internal rate of return, you just get the annuity, you divide by present value of cash outflow, you multiply by 100%. You take that annuity, you divide by the capital of the present value of cash outflow, you multiply by 100%. Number D, in case of unequal cash flows. Now, in case of unequal cash flow, this where, for example, you have a project for 3 years, 1, 2, 3, and then you get the cash flow, they are totally different. 10 million, 9 million, 7 million. So in case of this project, how do we determine the internal rate of return? So to determine the internal rate of return, this is the formula. You'll be taking ROA discounting rate plus NPV using the ROA discounting rate. You divide by NPV using the ROA discounting rate minus NPV using higher discounting rate. And then all of it you multiply by higher discounting rate minus ROA discounting rate. So that's the formula you use. This means the ROA discounting rate plus NPV using the ROA discounting rate divided by the NPV of ROA discounting rate minus NPV using higher discounting rate. And then you multiply by higher discounting rate, you minus ROA discounting rate. And that marks the end of today's session. So that's the end. So first of all, you look at that formula. In the handout I have indicated an illustration. You can be able to follow that illustration, plus the steps I have given there. So thank you for your time. We meet for the next session.